the most important thing to take away in step 2 is have I spent the money? Have I spent it on the right things to maximize my debt forgiveness over here? You have now received your money. You've received the loan. Now we're going to be looking at how to spend it right. And why are we spending right? One, we need it, but also how to spend it right. And then when we get over here to step 3 and we do our loan application, we're going to have it forgiven.
And for people who skip the first round, if you're a small business out there, you haven't applied for the PPP loan, go back and watch step 1. There's some good tips for you.
What you may want to look at in our video in step 1 is some pitfalls that were real world, my clients,
right.
As I mentioned, in the step 1, I've already visited, between Debbie and I, we visited with now over 20 clients in the last week that's in step 2, almost at the end. And we're finding that not all loans are the same. We're finding not all banks are the same. So I think step 1 is really good when you get ready, when you're documenting your 8 weeks in your step 1 to say, what's the money? And I think that's the other thing. Remember, the forgiveness can only be the amount of the loan. So in this period of 8 weeks, what a lot of people did, they put it in a separate bank account, or what they did is they put it on their QuickBooks or whatever they were using as a number and in paying it out of that account. So however you're doing it.
Why did they put it in a separate bank account?
Because the theory of putting it in a separate bank account is I wrote the checks out of that account. I would check to see if that expenditure was qualified for debt forgiveness. It met the payroll, it met the rent, it met the interest, it met the utilities, those other things that we can spend it on. See, step 1, payroll determined it. That was it.
Right.
Well, I should say, I have to watch this because in step 1, payroll is payroll plus the self-employed. In step 2, we're going to find out that payroll cost includes both of them. So even the semantics of words sometimes confuses. So
if you have, if you put it in a separate account, then those expenses are separate than your normal expenses that you're doing. So when you need to give all of your documentation, you already have all of those expenses separated from your normal business activity.
It just has that money.
It just has that money.
Mixing it in.
You're not mixing it in. So then it's a lot easier when you go to show the documentation of what you spend it on to be able to show it to the bank.
Well, Laura, I think that brings up an interesting note. And again, as we talk here, I'm going back to my real world. I'm going back to experience here. We're 2 months into this. And so, for example, right out of the gate, somebody said, well, we want to put in a separate account. Well, their payroll comes out of another account.
The one they usually use.
So what we did there, instead of switching the payroll to a different bank account, what we did is at the end of each payroll, we determined the qualified expenses and wrote a check out of that special account for qualified expenses and transferred it over into the general account.
It's like the normal operating account.
Yeah, because think of it. So it's sometimes little things like this that helps. So
go to your accountant, figure this out.
Yeah. So, but, and again, we've got to realize we think of this as banking. But every step of the way, anytime you get into documentation, compliance, writing a check, that goes through the bank. But the small business or their accountant has to keep track of this because when, again, we get to step 3, we have to make an application to the bank for the forgiveness. And we're just now, this week, seeing various banks come out with, here's our loan forgiveness application. Well, the application is from SBA. So what's the big deal? It's because, as we said in step 1, is that, some banks said, just keep good books and records. Some banks said, we want you, think about a separate account. Some banks said, here's a spreadsheet to keep track on. And some banks, there was no real communication. Realize when we get to step 3, we're going to be applying to debt forgiveness to our bank.
So I think a big question about spending the money the right way, getting it qualified for the debt forgiveness, is how to spend it. And you hear a lot about this like 75-25 ratio. What is that exactly?
Okay, so the 75-25, I think a lot of time you'll see both, but a lot of times you'll see 25 and not 75. And here's why. I love these terms in government. The interim final rules. I don't know how interim and final go together, but
Yeah.
well, actually, just a sidebar note. They actually did. This is SBA. SBA did interim final rules. Then a few days later, they came out with interim final rules to the interim final rules of the PPP. That one is much more complex than a country boy in the Ozarks can understand. But so when you look at the interim final rules, what it says, and this was determined, they didn't want it just, here's your money and go spend it. So the interim final rules from SBA says you cannot spend more than 25% on the other covered expenses, meaning you have to spend 75% on qualified or covered, because some places they use covered, some places they use qualified payroll. So 75 on payroll, qualified payroll, and again, that we go into great extent in step 3 because we're looking at the application for forgiveness. So there, what is covered under the operating expenses of utilities, rent, and interest, those things have a specific word called covered, but we go to the debt forgiveness application because that's the most recent interpretation of what is a qualified or covered expense. But 75 on payroll, including qualified benefits. And again, we go into that in great detail. That's a whole nother huge section in step 3.
In the 75%, the covered payroll, does that include the owner's payroll or earnings?
The quick answer is yes. The crazy thing is that how they approached it in applying for the loan, they separated very distinctly between payroll and self-employed people. Matter of fact, if you were self-employed, you were a 1099 truck driver, or you were a realtor or a consultant, or
Right.
What happened there was that was 1 week later than those with payroll. But back to your question, Laura, is that when it says payroll cost, in that case, that includes the owner. And I think that also takes us to an additional important, very important step. And that is when we were in the loan application, we looked at in that we talked about Schedule C, line 31. That's your earnings, or we talked about the K1 for the partner, for their earnings, how they paid themselves. That was just based on tax information or financial statements. Step 2, it appears that the owner should be paying themselves checks over the 8-week period for their qualified amount.
That's what the owner would do to show documentation to the bank account.
Exactly.
To the banker. Yeah. Okay. And then we want to make sure to clarify how that owner is going to pay themselves. If that they're a sole proprietor or partnership, how would they pay themselves?
They're going to pay themselves not through payroll. Self-employed, that's exactly what it means in tax law. Mm-hmm. You pay self-employment tax. You do not pay yourself through a W-2, even though for the loan, it's technically includes as payroll cost. Mm-hmm. And I wish they'd have separated it better, but they didn't. But the thing about it is again, it's what are you paying yourself? And so that would be a draw. That'd be an owner's draw or a partner's draw.
And then for a S Corp or C Corp, it makes it a little easier because they can be paid out of the W-2 wages. And so you have that documentation already. You don't have to worry about the partner draw or the owner draw.
Right. Because again, let's say we had a C Corp or an S Corp. In step 1, the only thing qualified was wages. Had nothing to do with profit or loss of the company. In step 2, it has to do with wages, not profit or loss of the company. And again, very consistent with tax law.
Okay. So we talked about the 75% needs to be qualified payroll. Now the 25%, what are those covered costs?
They're mainly in 3 areas. They're mortgage interest, their utilities, and then their rent. So that's just the 30,000 feet overview. So let's start to move on down. And for example, mortgage interest. One of the spreadsheets I was looking at one of our clients, they were including the loan payment. That does not qualify. It's only the interest. Secondly, that loan had to be in place February 15th of 2020. So you couldn't just run out and get a loan and pay the interest during the period. So in you cannot, in each one of these areas, the general rule, you can't prepay. In other words, mortgage interest, I can't prepay. There is some confusion, but it appears through frequently asked questions with SBA and think tanks that if I have a mortgage payment monthly, I'm paying the interest out of it. But what happens if it comes due in this period for 6 months? It's still mortgage interest. And then we'll go on. I would say the next one is that's covered mortgage interest. Then let's go to covered rent. And the reason why I'm using the word cover is that's exactly what it says. It's covered mortgage interest, it's covered rent, and it's covered utilities. So if you're doing a Google search, look for that. But under covered rent, it's rent or lease. The rent or lease had to be in place before February 15th, 2020. Every one of these is before February 15th. They don't want you to go out and play the game of, now I'm going to go out and rent a Mercedes or whatever. So, but it can be rental or lease. It can be on real property or tangible personal property.
So real property would be like a building, your office space,
Yes.
something like that. And then the personal property would be like the car you're driving, the copying machine, different things like that you have a lease on in your business, correct?
Yes. And the thing about it is as we mentioned in the opening, whether you have a separate bank account, even then, we've helped clients have a spreadsheet to where they can put all the documentation in, have the running totals. The most important thing to take away in step 2 is have I spent the money? Have I spent it on the right things to maximize my debt forgiveness over here? Remember, the day this hits your bank account, the day you hit the bank account, that 8 weeks, the clock starts that day, except for payroll. And payroll, it can start that day, but what happens is if I get it to, if you got it on April 5th and payroll wasn't until April the 8th, then we will cover over in the section on payroll in step 3, again, because that's where we do our final decision making on what number to put on the app, is to go back to step 2 and look at all your expenses and look what it is. Because again, it's like, it sounds simple. When you get to the bank in step 3, if we don't have all our ducks in a row, then we're not going to maximize our forgiveness of our debt.
So in the 25%, they said that there's 3 different areas. One was covered mortgage, one was covered rent, and the third one, would that be utilities?
Yes, covered utilities. And the crazy thing was the definition of utilities. For example, they got transportation in utilities. How do you get there? But it is.
Yeah.
So that's why I say that, if we in each one of these sections went through all the definitions, we'd never get through the point. So what we're trying to do here in step 2 is really get the concept down on what does qualify. But over under utilities, it's gas, it's transportation, it's telephone, it's internet. So there is a list of what qualifies. The only thing is like most of the time, they've got a list of what is included, but, like transportation, what all does that include? We know that, it includes like gas. There's no guidance out there on any allocation of like wear and tear. How many, I hope we don't have to get down to what was the wear and tear on the tires on the delivery truck. And remember, on all these, the covered utilities, the covered rent or lease, and the covered mortgage interest all had to be in place prior to February 15th of 2020.
So your loan amount that you receive is determined in step 1. We already covered that in step 1, and that's why they get the number. But what if I end up hiring more people and pay more payroll? What can I do then?
Again, here, looking at the chart, step 1, we got an amount of money approved for a loan. We're now in step 2, and your question is, I have more payroll. I have spent on more. you can never get forgiven more than the full amount of the loan.
Could I go back and get more?
No, this is a one-time shot. And it was very specific. You have a one-time shot at this. They're trying to, so people don't play games with it. So you can, and I think that brings up another question, whether I have more payroll or whether I have more other expenses. Once I get over that threshold, that's all I can never get more forgiveness than the loan amount. And literally, you could actually have payroll be greater than 100% of the loan, and that's okay. I think that's, so again, the question I think you started with, it's not you have to spend 75% on payroll. It's that you cannot spend more than 25% on other than payroll, which means, and that's why, again, you have the 75-25. The 25 is the driving force. I could have 100% in payroll and be okay. I could have, but I can't have more than the 25. Debt forgiveness in step 2, debt forgiveness is limited to the loan. Just be sure, and just before you cross this line from 8 weeks into step 3, be sure that you've checked that 1, you've spent enough, 2, that is qualified expenditures or covered expenses, and 3 is to review your full-time equivalents. Again, that's covered, the full-time equivalents. Those rules are so complex. We will do a total separate portion in step 3 to that. I think we're through all the questions and stuff, but step 3 is going to be what everybody is after.